Imagine your investment paying you back so handsomely that it could double your initial stake in just a handful of years, not through risky market growth, but purely through cash payouts. It sounds like an investor's fantasy, doesn't it? Well, right now, four colossal companies on the London Stock Exchange are offering this tantalizing prospect, boasting jaw-dropping dividend yields of more than 8%. This is the kind of number that makes even the most seasoned investor sit up and pay attention. But here's the multi-billion-pound question that we must ask. Is this a golden ticket to financial freedom? Or is it a cleverly disguised trap? It's the financial equivalent of a siren song, beautiful and alluring, but with a notorious reputation for leading investors towards treacherous shores. We're talking about the infamous yield trap, where a high dividend is merely a prelude to a catastrophic stock price collapse and a dividend cut. Yet, on the other side of that coin lies the holy grail for value investors, a genuinely undervalued, cash-rich company that the market has unfairly punished. Discerning one from the other is the ultimate test of investment skill. Today, we are embarking on a deep dive investigation into the FTSE 100's most exclusive and perhaps most dangerous high-yield club. We will meticulously peel back the layers of corporate reports and market sentiment for four household names to uncover the unvarnished truth. Is this eye-watering yield a sign of a company so undervalued that it's the bargain of the century, or is it a final, desperate cry for help before the dividend check is torn up for good? In this analysis, we will dissect a global advertising giant teetering on the brink, a major homebuilder trying to construct a future on shaky ground, and two colossal insurance behemoths with centuries of history and hundreds of billions of pounds hanging in the balance. By the time we're done, you'll have a crystal clear picture of which of these 8% plus yields might be a strategic addition to your portfolio and which one could be a catastrophic financial landmine. Let's begin with the stock that many analysts believe has danger written all over it in big, bold red letters: WPP. This isn't just another company. For decades, WPP has been the undisputed king of the advertising world, a global conglomerate with its influence felt in every corner of the marketing universe. If you were a global brand with a message to sell, WPP was the first, and often only, name on your list. Yet here it is, flashing an 8% plus yield that feels less like a boast of strength and more like a potential distress signal. The catalyst for this concern was a recent and chilling profit warning, a formal statement that sent a palpable wave of fear through the investment community. Why the panic? Because the very lifeblood of a company like WPP appears to be clotting. In a world currently gripped by severe global macroeconomic uncertainty, the first expense that corporations mercilessly slash from their budgets is almost always advertising and marketing. It's a classic, predictable corporate reflex, and WPP finds itself squarely in the firing line of this worldwide trend of fiscal belt-tightening. Consequently, its top-line revenue and its bottom-line profit are both under significant pressure. Its profit margin, once a source of pride, is being squeezed tighter than ever before. But this isn't merely a cyclical downturn that will pass when the economic seasons change. Oh no, what WPP faces is a threat far more fundamental, far more existential. The real monster lurking in the corporate shadows is the relentless march of artificial intelligence. We are talking about sophisticated AI applications that are fundamentally democratizing the creative process itself, empowering businesses, even small startups, to bring complex creative work in-house. Why, a CEO might ask, should I pay a massive agency millions of pounds when a cutting-edge AI can generate entire campaigns, write persuasive copy, and design stunning visuals for a tiny fraction of the cost? This isn't some distant, futuristic threat. It is happening right here, right now, and it is striking a dagger at the very heart of WPP's long-standing value proposition. For generations, the big idea was the exclusive domain of sprawling, expensive creative agencies. Now, generative AI platforms can brainstorm thousands of concepts, write compelling marketing copy, produce professional-grade video content, and even compose jingles, all in a matter of minutes. This technological earthquake is shaking the very foundations of the agency model, forcing WPP to not just compete with other humans, but with algorithms that never sleep, never take vacations, and never demand a raise. Now, it would be unfair to write the company's obituary just yet. Despite these almost biblical woes, WPP is not on the verge of collapse. It still projects an operating profit somewhere in the region of £400 million to £425 million for the first half of 2025. Furthermore, it continues to hold contracts with an impressive roster of blue-chip clients, the kind of corporate royalty that values long-term relationships and doesn't just jump ship at the first sign of trouble. And let's not dismiss the countless prestigious industry awards that adorn its trophy cabinets. But at the end of the day, trophies don't pay the bills, and they certainly do not guarantee the sustainability of a dividend. The verdict from the source analysis is stark and unequivocal. There is simply too much dense, impenetrable uncertainty clouding not just the stock, but the entire advertising industry to make this a comfortable investment for the risk-averse. It represents a high-stakes gamble on a legacy giant fighting a desperate war on two fronts, a punishing global economic slowdown and a technological revolution that threatens to render its entire business model obsolete. But while WPP is fighting for its very identity, our next company is quite literally building the future. Or is it just building on fragile foundations? Let's turn our attention to Taylor Wimpey, one of the United Kingdom's largest and most recognizable home builders. This company presents a fascinating case study in resilience. For the last 4 years, it has been one of the most generous dividend payers on the entire London Stock Exchange, paying out between 8.58 pence and 9.46 pence per share. What makes this so impressive, so utterly remarkable, is that Taylor Wimpey has managed to do this against the grim backdrop of a deeply troubled UK housing market. Soaring interest rates, designed to combat inflation, have made mortgages prohibitively expensive for many. This, combined with a brutal post-pandemic squeeze on disposable incomes, has shattered consumer confidence and cooled the once red-hot property sector. Yet, through all of this, Taylor Wimpey kept the dividend checks flowing. And now, there are tentative signs, mere glimmers on the horizon, that things might be picking up. These are the possible green shoots of recovery. Excluding its joint ventures, the company now expects to sell between 10,400 and 10,800 homes in 2025. To put that in perspective, last year, it completed 9,972. It's a modest but meaningful step in the right direction. However, and this is a significant however, the housing market remains exceptionally fragile. It's like a patient just out of intensive care. Any unexpected shock, such as interest rates not falling as quickly as the market hopes, could easily trigger a relapse and send the market slumping once again. Furthermore, it could be several years, if ever, before the group is able to recapture its fat pre-COVID profit margins. The economics of building have changed. Supply chain disruptions have inflated the cost of everything from timber to concrete, while a persistent shortage of skilled labor continues to push wages higher. These are stubborn headwinds that won't simply vanish overnight, putting sustained pressure on those once enviable profit margins. But Taylor Wimpey has some powerful weapons in its arsenal. It boasts a strong balance sheet, giving it the financial resilience to weather further storms. This isn't just corporate jargon. A strong balance sheet means manageable debt levels and significant cash reserves, giving Taylor Wimpey the crucial flexibility to buy land opportunistically when rivals are forced to sell, or to continue its building programs even during market lulls. It's a financial shock absorber that is indispensable in a cyclical industry like property development. It holds a vast number of plots on which to build, a land bank that is the envy of its competitors. And it has a healthy order book currently valued at a staggering £2.26 billion. This gives it a degree of visibility into its future earnings that many companies can only dream of. The final analysis? Taylor Wimpey is a compelling contender, a story of strength and adversity, but one that is certainly not without its risks. This incredible balancing act between palpable risk and tantalizing reward is the very essence of what investing is all about.
If you're finding this granular breakdown of company fundamentals useful and engaging, do me a quick favor and tap that like button. It's a small click for you, but it's a massive signal to me that you want more in-depth content just like this.
Now, let's pivot from the tangible world of bricks and mortar to the more abstract, but no less critical, realm of finance and insurance, a sector often seen as a bastion of stability. Or is it? Our third heavyweight contender is Legal & General, a name that has been a bedrock of British finance for nearly 2 centuries. When it comes to dividends, this company is royalty. With the single exception of the year 2020, when it wisely chose to hold its dividend steady amidst global panic, this financial giant has increased its payout to shareholders every single year since the great financial crash of 2009. Let that sink in for a moment. Through sovereign debt crises, Brexit, and countless other storms, Legal & General kept rewarding its investors with more cash. Not only that, but it has publicly pledged to continue this trend, promising to raise its dividend by 2% per annum from 2025 through to 2027. And the good news doesn't stop there. In 2024, it reported a healthy 6% year-on-year increase in core operating earnings per share. Despite this solid performance, its shares appear attractively priced, trading at around 12.6 times their historic profit. On the surface, it looks like a slam dunk, but there is a colossal risk lurking on its balance sheet, an elephant in the room so large it's hard to comprehend. The group has over £500 billion of investments. That's £500 billion. This massive portfolio is intrinsically linked to the health of the global economy. If a severe global slowdown were to occur, or another financial crisis were to erupt, the value of these investments could plummet, which would directly impact investment income and could, in a worst-case scenario, force a cut to its cherished dividend. A significant portion of this £500 billion portfolio is invested in assets like corporate bonds and commercial real estate, which are highly sensitive to economic downturns. A wave of corporate defaults or a collapse in commercial property values would directly hit Legal & General's capital base. Competition in the insurance and asset management space is also fierce, which could eat into future earnings. Nevertheless, the counter-arguments are strong. The group's robust balance sheet is designed to withstand shocks. Its pipeline of new business is impressive, and its long, almost unbroken, track record of dividend growth provides a powerful reason for investors to keep the faith. It's a classic case of a dependable giant, but one with a £500 billion question mark hanging over its future. And that brings us to our final company of the day, Phoenix Group Holdings. It operates in the very same sector as Legal & General, facing similar challenges from both established titans and nimble newcomers. However, Phoenix Group is the smaller, arguably scrappier cousin. Its market capitalization is less than half that of its larger rival, which, in simple terms, means it has less financial firepower to withstand a severe economic downturn. Compounding the issue for investors is the fact that since July of 2020, its share price has been frustratingly flat. For years, investors have looked at this stock and seen their capital go absolutely nowhere. It has been the definition of dead money. But then you dig into its 2024 results and the entire narrative changes in a heartbeat. The numbers are, to put it mildly, spectacular. Compared to the previous year, 2023, its adjusted operating profit was up by a staggering 31%. Its operating cash generation, a key metric of financial health, was 22% higher, and its assets under administration grew by 11%. These are not just good numbers, they are knockout figures that suggest a company firing on all cylinders. The market's previous pessimism was understandable. Phoenix Group specializes in acquiring and managing closed-book life insurance policies that are no longer sold to new customers. For years, this was perceived as a low-growth legacy business in terminal decline. What the market missed, however, was the group's exceptional efficiency at managing these books and its savvy acquisitions, which have supercharged its cash generation. The recent spectacular results were not a fluke. They were the culmination of a long-term strategy finally bearing fruit. Furthermore, the group owns some of the most well-known and trusted brands in the UK financial landscape, including Standard Life and Sun Life, giving it a powerful competitive advantage.
And to top it all off, it has successfully increased its dividend for the past 6 consecutive years. For these reasons, the analysis suggests this is a stock that long-term investors should seriously consider adding to their portfolios. We've dissected 4 massive companies, each with its own unique story of risk, reward, challenge, and opportunity. To make sure you never miss our next investigation into the market's hidden gems and potential traps, take a moment to hit that subscribe button and turn on all notifications. You really won't want to miss what we have coming up next. So let's pull it all together. There you have it. 4 FTSE 100 giants, 4 dividend yields north of 8%, and 4 profoundly different stories. First, we have WPP, the troubled advertising titan grappling with a severe identity crisis in the relentless age of AI. It's a turnaround play that requires a huge leap of faith. Second, we have Taylor Wimpey, the resilient home builder, expertly navigating a fragile market but still vulnerable to economic headwinds. Third, there is the venerable Legal & General, the dependable dividend machine with that £500 billion sword of Damocles hanging over its balance sheet. And finally, we have Phoenix Group, the underdog that was ignored by the market for years, but is now punching well above its weight with spectacular recent results. The ultimate takeaway from all of this is a timeless investment lesson. A high dividend yield is never, ever a free lunch. It is a flashing neon sign that demands and deserves your deepest investigation. It can signal profound, overlooked value, or it can signal profound, imminent trouble. The key, as always, is to look beyond the tempting headline number and take the time to understand the intricate story behind the stock. So as you consider these 4 titans, ask yourself the hard questions. For WPP, are you betting on a legacy giant to successfully reinvent itself against a technological tidal wave? For Taylor Wimpey, is your risk tolerance aligned with the volatile cycles of the property market? For Legal & General, do you trust its centuries of experience to navigate the next global economic storm? And for Phoenix Group, do you believe its spectacular turnaround has sustainable momentum? Your answers to these questions will reveal far more than the dividend yield ever could. They will define your path as a thinking investor.